You wake up, check your phone. Bank app says $10,000 safe in savings. But right now, that money isn't locked in a vault. It's racing across Wall Street, fueling bets on Tesla stock, or Apple, or whatever crashes next. You didn't place those bets, but your savings just did. Imagine this: your hard-earned cash, paycheck after paycheck, sitting pretty in a savings account, earning 0.01% interest if you're lucky. Feels secure, right? Wrong. Banks aren't vaults. They're casinos with better suits. And your money, it's their chips. Why does this matter now? Banks are closing branches left and right. Markets swing wilder than ever. Inflation eats your balance while headlines scream recession fears. President Trump's back in office, pushing deregulation. Wall Street's partying. But your savings? They're the quiet fuel keeping the slot machines spinning. In 2025, with rates volatile and runs popping up at regional banks, one question haunts: is your money really yours? Let's trace it. Step by step, you deposit $1,000. Bank thanks you, but they don't stack it in cash. No, fractional reserve banking. Old as dirt, but sharper than ever. Law says they keep a sliver, say 10% or less, depending on rules, in reserve. The other $900, out the door, fast. First stop, loans, your neighbor's mortgage, small business expansion. Solid usually, but it chains. That business borrows, then invests in stocks. Or your bank lends to another bank. That one buys bonds, bonds backed by more loans. Suddenly, your $1,000 ripples into a dozen hands. Now the twist: banks don't stop at safe bets. They park chunks in treasury bonds, safe-ash, but others, they bundle deposits into assets. Sell to hedge funds, those funds. They leverage it 10 to 1, borrow more using your money as collateral, then drop it all on stock market derivatives. Calls, puts, bets on whether Nvidia skyrockets or tanks. Your savings, collateralized, just funded a multi-million gamble. Escalating. Banks hold $18 trillion in U.S. deposits, but cash on hand, peanuts. Federal Reserve data: reserves hover around 10% max. Rest multiplies through interbank loans, repo markets. Your deposit becomes fuel for proprietary trading desks. Not directly, rigs limit that, but indirectly, absolutely. In 2008, it was subprime mortgages. Today, tech bubbles, crypto echoes, same game. Uncomfortable math time. Leverage math. Say a bank uses your $1,000 deposit as base, lends $900. That borrower deposits elsewhere, triggers another $810 loan. Snowballs to $10,000 in the system from your buck. Multiplier effect. Genius for growth, disaster if panic hits. Everyone withdraws, bank run. No cash, collapse, happened in 1930s. 2008. Silicon Valley Bank 2023. Your FDIC covers $250,000 per account, but if 10 banks fail, government prints. You foot the bill via inflation. Hype says, your money's FDIC insured, safe as houses. Ads glow. Earn while you sleep. Reality. Banks chase yield. Post-2022 rate hikes, they dumped long bonds for stocks-adjacent plays. Irony: you save for security, they risk it for bonuses. Absurd: your grandma's nest egg props up a trader's yacht. Zoom out, bigger web. Your savings grease the economy. Loans spark jobs. Investments build companies, but fragility baked in. One market dip, say AI hype bursts and hedge funds call loans. Banks scramble, deposits frozen. 2025 risks. Trump's tax cuts juice stocks, then debt spikes rates. Eurozone wobbles. China slows. Chain reaction: your $10,000, not gone but trapped until bailouts. Quiet humor in the madness. Banks preach caution to you. Don't invest what you can't lose. Meanwhile, they leverage your caution into high-stakes poker. Skeptical? Check Fed balance sheets. $7 trillion still bloated from COVID. System's a house of cards, balanced on trust. So next time you glance at that balance, ask yourself, comfortable funding strangers' stock bets, with no say. System holds for now. But what if the music stops, your move or theirs fade to black?